I am. I'm on mute.
Well, good afternoon and welcome to HIROC's weekly webinar where we will talk about what we see happening in the global economy, financial markets, and the world of wealth management and how all of this impacts our decisions on the best courses of action for our and your investment strategies. We invest our money in the exact same models as our clients, and we think that this defines the true nature of our prudent and disciplined investing strategy. Our discretionary management enables us to make quick decisions and execute them immediately for all of our clients simultaneously, which is especially important in volatile markets as we take advantage of the opportunities that avail themselves to us. I'm Scott Tomlinson, and we are joined on the call by my partner and colleague, Paul Tepsich, the founder of HIROC, and also joining us is our certified financial planning professional and wealth forecast specialist, Bianca Tomlinson. We are recording this webinar so that those who can't join us live can tune in when it is more convenient. If you are a first-time listener and would like a little more information about our private client services and our disciplined investing strategy, we have a separate introductory webinar that will provide you with this. And all you need to do is visit our homepage and click on the Introduction to HIROC Private Client button. And while you're at it, you may be interested in our voluntary code of conduct as well, something that we think takes us above and beyond the regulatory requirement in many ways and highlights how we always put our clients' interests before our own. Okay, as we always do, let's start with a quick review of our themes for 2017. We think that our strategy of having a tactical perspective to investing is even more important in 2017 because of the even greater levels of uncertainty imposed by an onslaught of evolving factors. Inflation is an important determinant of central bank policy, and while most central banks have been more cautious, the U.S. Federal Reserve raised rates by 0.25% on March 15th and is expected to do so in June and at least one or possibly two more times after that this year. Stock prices and valuations are at 14-year highs, but excess liquidity has been driving most stock markets. What happens when central banks start to turn off the liquidity tap? Well, we'll talk about that a bit further along in the program. The Trump agenda has run into some political hurdles. Brexit has been initiated, and the French elections have rejected populism. Meanwhile, protectionist concerns continue to rise, especially in Canada, and throw in escalating tensions with North Korea, global cyber attacks, Russian controversy, and new terrorist attacks, and we have quite a blend of political uncertainty in front of us. One of the reasons that we try to have a more tactical approach to investing over the old school buy and hold strategies is the changing nature of long-held correlations between stocks and bonds, both in the U.S. and in Canada. Well, Paul, it looks like those correlations are widening at the moment. Any comments on this?
Well, the higher that blue line goes in the bottom part of the graph, the more protection we will get from owning government bonds should equity markets fall off. So it's still providing us, in fact, well, today versus a week or 2-3 weeks ago, it's providing us with even more of a potential hedge. So it's moving in the right direction for us to continue owning government bonds.
Thank you. When we began our advanced approach to portfolio management back in 2015, we added a third model to a standard buy and hold balanced portfolio of equity and fixed income to try and find a new way to add value to client portfolios by reducing risk and maximizing risk-adjusted returns. And we are patient, waiting for opportunities to buy assets. Each week we look at the benchmark indices performance to allow you to make comparisons to your own portfolio performance. We take the allocation to the benchmark All Country World Equity Index, ETF, and blend it with the Canadian Bond Index, ETF. And that gives us a weighted return for comparison purposes. You may note that while the one-year blended benchmark net of fees has returned about 12%, the two-year annualized return has only returned about 2.87%, which highlights the volatility over the last couple of years. Now, our focus is on reducing volatility in our portfolios in order to avoid big swings in return. And as we look at a longer-term HIROC Private Client, the one-year total return performance after fees is 9.3, which is a little bit behind the benchmark. But with about 25% in a money market fund, this portfolio is significantly less exposed to expensive risk assets like equities, which we believe are vulnerable to at least a 10% correction in the not too distant future. But the longer term, 4.5-year performance is still well ahead of the benchmark, a sign that we have been successful in lowering short-term volatility, which enhances long-term returns. At HIROC, we focus on the difference between the absolute returns and risk-adjusted returns. The actual HIROC Private Client return per unit of risk taken on an apples-to-apples comparison basis significantly outperforms the 60/40 comparative benchmark. And graphically, you can see that the absolute return for the HIROC Private Client is higher and the risk taken is significantly lower. And we remind everyone listening that historical returns are no guarantee of future returns, but at HIROC, as you also know, we work very hard to provide our clients with the best possible risk-adjusted returns. We also believe that it is crucial that we review your wealth forecast on a regular basis so that we can ensure that your long-term goals are in line with your portfolio strategy, and our forecasts for your net worth into the future are up to date and heading in the right direction. Inflation is one of our key themes for 2017 as we try to assess the implications of easy central bank monetary policy on the current global economic growth. We see expectations of tax reform and infrastructure spending by the Trump administration raise the outlook for a scenario of increasing inflation in the U.S., but so far this year, we have not really seen this following through. Well, in Canada, the Consumer Price Index rose 1.6% on a year-over-year basis in April, matching the gain in March. Overall, energy prices rose more year-over-year in April than they did in March, while declines in food prices moderated. Now, excluding food and energy, the CPI was up 1.5% on a year-over-year basis in April, following a 1.7% increase in March. So if you drive a lot and spend money on education, you may have a higher cost of living than the average. Now, if you eat at home and do not dine out, you may find yourself with a lower cost of living than the average. So it really is contingent upon your own personal consumption habits, and we like to talk about those when we work with our clients and their wealth forecasts. As for the Bank of Canada, without an advance in CPI to at least their 2% target across all of their core indicators, monetary policy and interest rates will likely remain stuck in their current place. They will announce their latest decision on interest rates tomorrow, so we'll be staying tuned to that. As all central banks have a mandate to maintain price stability, this year we are focusing on inflation data as a key to determine if and when interest rate policy may change, and as I discussed in my blog this morning, when liquidity might start to be removed from the global financial system. The total inflation data, with the exception of the UK because of the impact of a depreciated pound sterling post-Brexit, remains below most 2% targets. The U.S. Federal Reserve began adding liquidity, the white line that you see on the chart, by purchasing securities starting back in 2009. That was called quantitative easing. They did 3 rounds of that to continue to drive that white line higher until 2014 when they stopped. But that liquidity that was added continues to draw stock prices higher. When the Fed decides to reduce this liquidity, stocks will lose part of their driving force. The Fed wants to gradually take this bubble away, but it is a delicate situation for them. European Central Bank liquidity has been supporting German equity markets and French equity markets. The Bank of England liquidity has supported UK equity markets, and Bank of Japan liquidity has supported Japanese equity markets. Now, the Bank of China has started reducing liquidity by raising short-term interest rates because they are concerned about high debt levels. This has pushed equity markets lower by about 7% in the last couple of months. So liquidity is absolutely key for stock prices to continue to rise. As long as there is ample liquidity, stocks will be supported. When it is taken away, that may not necessarily be the case. So we'll continue to be very cautious about what's going on with central banks. The expectations for U.S. rates to go higher are greater than most other developed economies, and that will begin to draw liquidity out of the U.S. system. Speaking of debt, global debt levels are growing at an approximate 5% per year, while the global economy is expected to grow only at about a rate of 3% per year. If interest rates rise, this puts increased pressure on servicing that debt. Canadian household debt is at record levels. U.S. household debt has jumped back to higher levels than it was in 2008. And emerging market countries have been building debt. And of course, as we mentioned, China tops the list. As for value and equity markets, you may have been reading the headlines that are telling us that first quarter earnings for 2017 are showing the best year-over-year increase since 2011. However, if you look closely at the first quarter 2016 starting point, it was a pretty poor quarter. So in fact, the actual earnings per share for the first quarter of 2017 are lower than they were in the third and fourth quarters of 2016. The 12-month forward-looking earnings per share, which will incorporate all the good news currently built in to share prices, expects another 10% increase. But the forward-looking price-to-earnings ratio is already at an expensive 17.5 times, while the 10-year average is at 14 times. As we all know, in time, prices do tend to revert back to their mean, which indicates that earnings will have to grow by a significant 20% more than currently expected, 10% than the currently expected 10% to bring the ratio back to its 10-year average. Either that or the S&P 500 will need to correct by 20%, or perhaps some combination of the two. Now, a reduction in liquidity in the system could prove to be the catalyst that undoes most of this. Now, another of our metrics of value, enterprise value to EBITDA, also shows stocks to be as expensive as they were at the time of the dot-com bubble. Stock prices have also been outperforming economic growth. So high equity prices equal high risk in owning that particular asset class. As we have proven, you do not necessarily have to own a full weight of that asset class to achieve long-term reasonable risk-adjusted portfolio growth. So for the moment, we are continuing to avoid being fully invested in equity assets. We would rather buy them after a 10% decline in price rather than before the 10% decline in price. So we shall remain patient. Okay, over to the geopolitical front. In the U.S., the health care bill was passed by Congress and is now being prepared to show to the Senate. The budget debate will resume in September. Now we await details of tax reform and infrastructure spending. President Donald Trump's budget proposal will next go to Congress, which will decide whether to turn the vision into reality. It is expected to face a difficult road on Capitol Hill, despite Republican control, given the competing factions within the Republican Party. Underlying the plan to eliminate the budget deficit, the White House is projecting a decade of rosy economic conditions. 3% growth, steady inflation of 2%, the jobless rate rising but only slightly to 4.8%, and modest interest rate increases. The kind of environment that would typically go in hand with strong worker productivity growth and a pickup in the labor force. Now, the Fed projects the economy will grow at a 1.8% annual rate in the coming years, and the Congressional Budget Office projects a 1.9% rate of growth. So there is a bit of a gap between what the Trump administration forecast is and the central bank and Congressional Budget Office. There have been some other distractions as we move along in the political spectrum. And as we discussed a few weeks ago, the Bank of Canada is concerned about trade protectionism, and the renegotiating of NAFTA could indeed be massive. The Trump administration has written to Congress, officially triggering the 90-day consultation period required before renegotiation of NAFTA with Canada and Mexico can begin. The letter says the Americans intend to initiate talks as soon as practicable, but no earlier than 90 days from this notice as required by current U.S. trade law. That means the earliest Canada's negotiators could be sitting down with their counterparts to discuss their opening positions would be August the 16th. Now, the letter did not, however, offer details about what the scope of these negotiations will include, so that remains to be seen. Germany warned that the reality of Brexit had yet to break through in London on Tuesday, or that's today, as the European Union unanimously agreed an accompanying negotiating mandate for exit talks. In recent weeks, member states have hardened the European Union stance, setting increasingly exacting requirements for Britain in the divorce stage of the negotiations to meet before trade talks can begin. And we are reminded yet again that terrorism is still a major issue, and cyber terrorism is a growing threat. So here at High Rock, with all the upheaval happening around us, we continue to monitor event risk, which we think is high, and price valuation, which we also think is high, and we will add or reduce holdings tactically in our models as opportunity presents itself. We will also maintain the disciplined approach to our strategies with skill, competence, and continued deep levels of research, adding value and reducing risk so as to give us all the best possible risk-adjusted returns. Paul, anything you wish to comment upon this week?
Not really, Scott. Unfortunately, we really didn't do any adjustments or any real trades over the past week, so there really is nothing else to report with regards to portfolio construction this past week.
All right. Well, there you have it. That does conclude today's webinar. As always, we want to thank you all for taking the time out of your busy schedules to tune in. If you do have any questions or concerns, we certainly want you to feel free to email them to us. We will be back with our next update next Tuesday. But until then, this is Scott Tomlinson. On behalf of my colleagues Paul and Bianca, we want to wish you all a great week.